All right. Hey, everybody. Welcome to the third installation of our webinar series on financial management. And today will be estate planning for healthcare providers, sponsored by Provident CPAs, a firm that I've personally been with as a client for several years now, and can attest to the quality of their work. And we thought so highly of them that we wanted to introduce them to the network because it's the best kept secret that I think we should probably share with our network, because we want you guys to have access to these guys too. So today we're going to be talking about estate planning for healthcare providers. As I mentioned before, our speaker today is David Auer, who is the founder of Provident CPAs and Physician Tax Solutions. And he has over 35 years experience as a CPA, a speaker, an author, business consultant. I've read his book. It's actually really good. He holds a BSBA and MS in accounting from Oklahoma State University. He's a cowboy, and a JD with honors from University of Oklahoma, and an LLM in taxation from NYU. David is also a personal financial specialist, chartered global management accountant, and a certified tax planner. And he's graciously going to be hosting this webinar today on estate planning. And without further ado, I'm going to pass it to Angie O'Day, who's his very sharp right hand, and I'll let you take it away from here.
All right. Thank you, Rafid. Thank you for joining us today, guys. I just want to talk about what our agenda looks like. So moving forward. All right. And our upcoming webinar is going to be really great for part 4. That will be on October 30th at 5 p.m. Eastern Standard Time. So we're going to cover the private insurance advantage. And we do have the QR code here if you want to go ahead and register for that. We welcome you to do so. So just a brief disclaimer, we want to say that, everything we're discussing today, tax planning wise, is going to fall within the 4 corners of the tax law. And our agenda, so we've got a lot of great things to cover today. First off, we're going to cover definition of estate planning. Next up, why estate planning is important. Basic estate and asset protection planning. Lastly, advanced estate and asset protection planning. And then we'll wrap everything up with Q&A. So be thinking of some things you guys want to cover as we get to the end of our presentation today. Now I will hand it over to David.
Well, thanks, Angie, and thanks, Rafid, for the kind introduction. Also wanted to mention that we also have Bill Bennett on the webinar. If you didn't have a chance to watch our second in the 4-part series on financial risk, I would definitely encourage you to go back and watch that. And then if you didn't have a chance to watch our first one, which was on tax planning, where I talked a little bit about the phase-in of several of the tax law changes that have happened over the last several years, and going into next year, knock on wood, Congress doesn't change anything, which they normally do. And then also compared the tax proposals of both of the presidential candidates and what they are proposing, to change or to stay, to keep the same. Also had Todd Hudgens' picture there in the intro. He normally would do this section on estate planning, and also we're going to talk a little bit about asset protection planning, because I know that's top of mind for those of us who walk around in a highly litigious society wondering where the next crazy plaintiff might come from. So I'll weave in toward the end some asset protection strategies as well. But normally, so we work with Todd Hudgens, who actually handles the estate planning and asset protection planning for our clients. But I know enough to be dangerous, so I'll be able to talk about the slides that he would have otherwise shared today. So let's first start off, just so we all have the same common denominator, to see if we all agree to the same definition of estate planning. So if I were to describe or define estate planning as wanting to have a plan to control my property while I'm alive and well, I'm assuming everyone would agree with that, that premise of having a plan to make sure that they have control over everything while they're alive. They want to be able to take care of their loved ones and themselves if they become disabled. Because obviously, as you know, if you don't have legal capacity, you're not able to take care of yourself anymore, and obviously any loved ones that you're in charge of. And that you want to give what you have to whom you want, when you want, and the way you want. So I would submit that would be, what most people would agree that, that how they would define estate planning. And then lastly, and certainly, very important, is wherever possible, they want to save taxes, court costs, and professional fees. So I start with this premise just because I think different people sometimes have different definitions of estate planning. What I've tried to do here is explain more of a comprehensive approach to estate planning, where it's not just a plan during your lifetime, but also in the event of an incapacity. But also equally important to make sure that at when you're no longer alive or able to manage your affairs, you have a plan in place to take care of your loved ones and your property. So let's talk a little bit about why estate planning is important. So you may have heard that if you don't have an estate plan, the state that you live in or the state that you have real estate generally has an estate plan for you. It's what is called intestate succession. But if you die without a will, you'll have an intestate estate, meaning that you died without a will. And so therefore, the state statute that governs how property is passed from a descendant to the next rightful heirs is going to control who gets what and how much. So one of the main reasons that you want to have estate planning in place is to possibly avoid the cost and the inconveniences of having a probate proceeding, which is merely a court process, generally started in the county where you resided at the end of your lifetime, or where you had your permanent residence. It also could involve a probate in any other state, or the county in any other state where you own real estate that you left in your own name. So typically that's going to be a separate court proceeding in each county court. And the process there, if you don't have a will, is that the court then is in charge of identifying what property you owned, what debts you had, who your next rightful heirs are, and then they manage or they approve the process of paying off the creditors, liquidating or marshaling all the assets in your estate, and then making sure that those go to the next rightful heirs after the creditors have been paid. That can be a very expensive process depending on the type of property and how complex your estate is. Generally, from state to state, it depends on what the laws of the state are, but it can be anywhere from 3 to 8% of the gross value of your estate, not necessarily the net value. So it can be very expensive. The other reason you may want to avoid having an intestate succession is that you have no control over who the beneficiaries are. And so some cases, your property may end up going to people that you didn't intend to have that property go to, and or in the amounts that you have. So every state has its own laws, but it would control who get whether and how much a surviving spouse would get property, if any living children or grandchildren receive property, if one of your children is no longer living, and then if you don't have children and a surviving spouse, then who upstream in your family tree would be the next rightful heirs, and as far as there is a living heir that's out there. So anyway, those are some of the unintended beneficiaries that may get your property if you don't have a plan to control that. So if you have a will, so that's one step. So first step would be to have a will. If you don't have a will, that can avoid the laws of intestate succession, but it will not avoid the cost and the inconvenience of and the delays that happen in probate. If you want to avoid both, you're going to need to have a trust that has been created during your lifetime. Ideally, it would be a revocable trust, so you can change it over, as things change or the laws change. But the first thing you want to do is have a trust that owns all of your property. So that is where the term fully funded comes in. But that is a trust that is set up during your lifetime. Sometimes it's called a living trust. Technically, it's called an inter vivos trust, one that is created during life. What some people have is they have a will that feeds all of the property after probate into a trust at the end of their lifetime, that is what's called a testamentary trust. So that is one that's set up as part of your last will and testament. Again, that does not avoid probate, but at least it does ensure that that the intended heirs receive the property on the terms that you've put in the trust. So ideally, minor children don't receive the inheritance until they reach some age of maturity. And then depending on how long you want that trust to exist, it has the controls that you want along the way. So either if you want to avoid probate and intestate succession, it's best to have an inter vivos or a living trust. If you're not concerned with probate, but you want to control who gets the property, then at least having a will with a testamentary trust as part of it would accomplish that. And the next area of concern would be taxes. So today we live in a relatively high estate tax exemption environment. So right now it's $13.61 million. It's adjusted for inflation each year. So what that means is a married couple, can die with owning as much as $27 million worth of property this year, or they can give that property away. So the estate tax exemption is also a gift tax exemption. So you can either give that property away during your lifetime and use up your exemption, or you can have it at the end of your lifetime to use against your total taxable estate. Keep in mind that is scheduled as of right now to go down to $5 million, and it'll be adjusted for inflation in the year 2026. So it's going to bring into the net a lot more people that are in between that $5 million and that $13 million spectrum. So if you have parents or family members that are in that range, you may want to make sure that they are taking some additional steps that to help mitigate that potential estate tax. Also, under our current tax, at the end of your lifetime, anything you have in your taxable estate gets stepped up to fair market value. What that means is that if you have a low basis investment, meaning that you bought it for a lower amount and it's appreciated during your lifetime, that basis gets stepped up to the new fair market value at death, so that whoever inherits that property only has to pay capital gains tax on any additional appreciation that happens between the date of death and the time that property sells. And then also keep in mind that maximum capital gain rates is 20%. You might also be subject to the net investment income tax of 3.8% as well. So anyway, those are some tax aspects to keep in mind when you're also talking about estate planning. How your property is titled is also very important. There's a number of different ways you can own title to property. One is what is called fee simple. So that's just owning property in your name. You can have also own property as tenancy in common, which is generally owning an undivided interest in that property with another, one or more other joint owners. Joint tenancy is another popular type of ownership, especially with married couples, and especially when you're young and you're just starting to acquire property and you may not have known the importance of having a will or a living trust. You generally would put that property in joint tenancy, which means that at the death of the first joint tenant, the property automatically, as an operation of law, goes to the surviving joint tenant or tenants. It also could be common with situations where you have a child and an elderly parent, where you're trying to avoid probate, and that child is the sole heir of whatever that property that's held jointly is. Tenancy in the entirety is a form of ownership in a handful of states. It also is fairly generally common with married couples. And then community property, there's a little bit over a half a dozen states that no matter how you own the property in that state, it's deemed to be owned equally between spouses. So just be careful that if you have acquired property in a community property state and you move outside of that state to another state, that property may continue to have be treated under property law as community properties, even though you've moved to a separate property state. So just be careful when you move states, that if you are moving into a community property state or you're leaving a community property state, that may impact how the property is titled. So you also have other ways that property passes from one person to another. Obviously, you could have beneficiary designations, which are what you see when you have retirement plans. where you've designated who you want that property to go to upon death. And also you have annuities and life insurance policies that will have a beneficiary designation. So again, that controls not necessarily whether it's fee simple or tenancy in common. If it has a beneficiary designation, beneficiary designation will trump that. So that's why owning property is very important to know, just so that you can control how much you can control how the property will pass in the event that there's a death to one of those owners. So let me tell you a little story about a couple of individuals that lived several centuries ago. But it's a story of two very wealthy individuals. One was Cornelius Vanderbilt, and the other was Mayer Rothschild. I like to tell this story just because it paints very distinct pictures of how these two individuals approached how their wealth was going to be transferred to the future generations. So Cornelius Vanderbilt, as you probably know by the last name, was a very wealthy individual here in the U.S. He built his wealth in railroad. He died in, I believe, the year 1877, and at that point, he was the richest man in the world. So he was, I don't know who that person is today, but let's just say it was Elon Musk. But anyway, he died with a total net worth of about $110 million. So that was a lot of money back then. He was a little bit philanthropic. He gave about $2 million of his wealth to a local university that changed its name to Vanderbilt University, thanks to that $2 million gift. The rest of his wealth went to his wife and children, and without very many strings attached. About 100 years later, so this was in the 1970s, they had a family reunion of the Vanderbilt family. And one of the surprising discoveries was that there wasn't a single millionaire left in the family. All of that wealth that had been inherited 100 years before from Cornelius Vanderbilt had been spent and dissipated among all of the future generations. And none of those family members had there was no significant amount of wealth still kept by that family. I contrast that story to another individual by the name of Mayer Rothschild. Mayer Rothschild was a banker. In his profession, he had 5 sons, and they all became bankers as well. And he approached his wealth a little differently. So in his situation, he created what he knew. He owned a lot of bricks and mortar banks, but he created something more conceptual on how he wanted to have his wealth managed in future generations. And so he created what in concept was a family bank. And basically what that meant was that nobody in the family got an outright distribution of property at the end of somebody's lifetime. But instead, they had 3 rules that governed how the family members could use that money that was passed down through the generations. The 3 rules were as follows. The first was, if you were a member of the Rothschild family, you could borrow money from the family bank, whether you wanted to go to get an education, you wanted to start a new business, or you wanted to buy real estate. You could borrow that money from the family bank, but you had to repay it. So that was the first lesson, or the first rule. The second rule was that when you did borrow the money and you paid it back, you were required to share all of the positive and negative experiences that you learned with everybody else in the family, both horizontally with siblings and cousins and nephews and nieces, and vertically with aunts and uncles and children and grandchildren, because they wanted all of that collective wisdom to continue to be passed down through the future generations. And the third rule of the Rothschild family bank was that you had to come back together every year to reaffirm the family values that Mayer Rothschild and his wife had set. So I probably don't need to ask the question, but I will, and that is, what do you think happened to the Rothschild wealth over the future centuries? And the answer is that they're one of the richest privately owned banking families that the world has ever seen. And the money continues to make more money, and the Rothschilds are all very prosperous as a result of that. So just to give you a little contrast about being in control of your wealth when you pass it on, and making sure that you have you pass it on to the right people and with the right values is very important. And you can see by these two individuals how much of a contrast those two can result in. So let's dig down a little deeper and give you some practical tools to take with you after this presentation. The first is I want to just go over what some basic estate and asset protection planning might look like. So we want to start with building a good foundation. So we want to first say, okay, if we want to keep it really simple, we may want to have just start with a will if you don't have a will. If you have minor children, I would very much recommend that you have a trust set up for to take care of them in the event that something happens to you. You certainly don't want to have minor children inherit that estate when they turn age 18. There's a lot of research out there about what happens when 18-year-olds receive inheritances, and it's not good, at least from the standpoint of perpetuating that wealth. If you want to go one step above, you want to have what I mentioned earlier, this fully funded revocable living trust. So that is a trust that you can change throughout your lifetime. You set it up during your lifetime, and it has all of the assets that would otherwise have to go through probate. And then you do have a will, but in this case, it's going to be a very simple will. It's what is commonly called a pour-over will, meaning that whatever you might have inadvertently or accidentally not put in the name of your trust gets just pours over. It has to go through probate, but it pours over and goes into the trust, and then all of your property then is controlled by what you put in the trust. So in addition, whether you have a simple will with a testamentary trust for minor kids, or you have the more intermediate one with a pour-over will and a fully funded trust, you might have some other important documents that accomplish different purposes. One would be, since your trust only controls trust property, you may also need to have a power of attorney to control, everything that happens outside of your trust that deals with other rights or accesses. So signing your name to a tax return, for example, or having access to a PO box. But you also may need one for healthcare reasons. So being able to have somebody that can step in and provide day-to-day instructions to your healthcare providers. And then ultimately, if it's needed, and depending on the state that you live in, either you have an advance directive or healthcare, or what's commonly called a living will, which deals with end-of-life decisions. So these three documents are generally, they complement the will and the trust to be able to take care of in the event that you have a disability during your lifetime. Special circumstances that may fall outside of those basics that you definitely would want to talk to an estate planning attorney who's skilled at these potential issues. One being how you want to treat children from a previous marriage. If you want to have them participate in your wealth. Like I mentioned earlier, minor children or children that have physical or mental disabilities, you may want to make sure you have provisions that take care of them. Spendthrift protection, which is just guidelines that keep the beneficiaries from having full access to the money with some rules attached. If it's important to pass the values that you've learned and value during your lifetime, pass on to future generations, you may want to tie that into your estate planning documents as well. So you can see the list here. It's not outside the realm of possibilities that a significant number of people have one or more of these type of issues come up. And I would just submit that you probably want to make sure you're talking to wise counsel that can walk you through what the choices are in each of these, and not necessarily just go look at an online website that you can print out a simple will and a trust if you do have some of these special situations that come up. Looking at a basic estate plan for a married couple and looking at having starting off with a revocable living trust. That trust basically would read like a timeline. So you end up having this trust during your lifetime. On your incapacity, you have these complementary documents ranging from a power of attorney to the living will on end of life decisions. At the end of lifetime, and if you leave a surviving spouse, there may be a period of time where all of the property in the trust is being accumulated and centralized. So it may be in an administrative time period. A period of time. This pour-over will, like I mentioned earlier, may go in and identify any assets that were not put in the trust during lifetime that would otherwise have to go through probate. So those assets would then go into this trust. And then as another, I would call it an ancillary document, but if you had certain items, personal property items that don't necessarily have title to it, but you want those items to go to certain family members, then having something that commonly is called a personal property memorandum that's referred to in your trust, that you may be able to leave, to give special instructions to some of that personal property that has sentimental value and or doesn't have a title to it. If you have a taxable estate, the first type of trust that generally is set up after the administrative period is a family trust up to the exemption, the lifetime exemption that exists at that time. If your estate is less than the exemption, then the only trust that is then funded is the family trust. But if you do have more property than what is in the family or the exemption, then that generally will pour over to or be distributed over to a marital trust. So the reason that this is important is that whatever goes into the marital trust is over the lifetime exemption, but if that trust is set up properly to the benefit the surviving spouse, it qualifies for what is called a marital deduction, meaning that your taxable estate then is reduced down to whatever the exemption is. So whatever is over the family trust amount or the exemption amount passes on at least when the first spouse dies without being subject to an estate tax. However, at the end of the second spouse's lifetime, if that marital trust plus whatever the surviving spouse's trust has is over the exemption, then they themselves would have a family trust. And if that is over the exemption, then there could be a possible estate tax, which, by the way, is currently 40%. So anything over that exemption amount is going to be taxed for federal tax purposes at a rate of 40%. And then if after the taxes, if any, and at the end of the surviving spouse's lifetime, if you want your wealth to continue for the lifetime of the children and or grandchildren, it would be possible to continue that trust or in separate trusts over the lifetime of those children, where they have access to that money, and then ultimately on to the next beneficiaries that you'd like to benefit. When we deal with the next level up, which is advanced estate planning, we may be dealing with things like life insurance, which is generally, if you own life insurance, you're going to have to. That's going to be another asset in your taxable estate. So if you're borderline to have that taxable estate exemption, you may want to push that life insurance to be owned by an irrevocable life insurance trust. Any new insurance policies, if you die after you create the trust, are not included in your taxable estate. However, if you transfer an existing policy into a irrevocable life insurance trust, there's a 3-year rule, meaning that if you die within 3 years, the proceeds are included back in your taxable estate. So it's better to get the clock running sooner rather than later if you have existing life insurance. Another common strategy for more advanced sizable estates is to create what is commonly called a dynasty trust, which allows there to be the grantor of the trust to also escape what is called generation skipping transfer tax. So that's a state tax when the future generations pass away. So there's an ability to exercise that generation skipping transfer tax exemption when the estate tax exemption is exercised, and therefore all future generations escape any estate tax. So that's something to keep in mind if you do have a larger estate. And then obviously if you are charitably inclined, and I would submit for your consideration that if you're over the taxable estate, you're probably charitably inclined, whether you or you're a philanthropist, whether you know it or not. If you don't redirect some of your wealth to your own charities, it's going to go to the government, and we know the charities that they like to benefit. So if you're over that exemption, again, you're probably better off taking control of that philanthropy and just making sure that it goes to the charities that are important to you. And then other ways of shifting wealth can include transferring interest, putting property in limited partnerships or limited liability companies, transferring some of those interests, especially non-voting interest in those entities, to future generations, and maintaining the control over those assets. But that also tends to get some of those assets out of your taxable estate. So just looking at an example of an advanced estate plan, having a life insurance trust, possibly a family limited partnership owned by your revocable trust, where you've gifted some of your interest over your lifetime to a dynasty trust, which is going to be for future generations. So that, and then controlling all of the assets in the limited partnership by owning the general partner interest, making your dynasty trust a limited partner. Therefore, then having the family trust that captures the amount of the estate tax exemption at death, the marital trust for everything above that, and then zeroing out that estate tax, possibly if there is an estate tax, with using what is described here as layered testamentary charitable lead trust. So that is basically a way of zeroing out the taxable estate by distributing money over the term of those charitable lead trusts to a charity of your choice or family foundation. And then at the end of that time period, that money then after those layers expire, all goes back into the family trust, which ultimately passes on in the form of its own dynasty trust to future descendants. So all of these trusts accomplish specific estate tax or generation skipping tax benefits, but then also ultimately keeps maximum control of the property in the family members' hands. Shifting gears and moving more to asset protection planning. So this is above and beyond just having a good foundational estate plan. One of the benefits of looking at asset protection is taking advantage of certain types of entities. There's about 13 jurisdictions that different states that limit a plaintiff's remedies in the event that they sue an LLC, to where they're all they can get is what is called a charging order, which is basically a lien against future distributions. So as you can see, a list of a handful of those states that offer that charging order protection. So if you are going to set up a limited liability company, you'll make sure that they're in one of these 13 jurisdictions. You can also go one step further, which would be to set up an asset protection trust. Those can be both set up, within certain states that offer domestic asset protection trust legislation. Different states offer different benefits, but there are a handful of states that generally have provisions that are generally preferred by the grantor. So when you're working with, if this is an area of interest to you, you definitely want to make sure you're working with somebody who can advise you on which states and how to create that trust to get maximum protection. If you're like me and a couple of other people that I talk to occasionally, and that is we don't necessarily trust our judicial system, meaning that the concept of a jury of our peers may not exist. Most of those kind of people are going to be voted off of the jury by the time it gets that far. So you may want to take asset protection to another level, which would look at another foreign jurisdiction that has very favorable laws against outside creditors and predators. So there's a couple of different jurisdictions. Isle of Man, Cook Islands. My favorite is the Belize asset protection laws. There are a couple of resources you can look at. One is a website down at the bottom called assetprotectiontraining.com. Rob Lambert, who is an expert in asset protection, goes through, has a lot of resources that talk about the pros and cons of different jurisdictions and what he recommends. So anyway, just keep that in mind. Again, these are not overly expensive, trusts to set up. They probably 20 or 30 years ago, these were $50,000 and above expenses. Now they're under $5,000 to $10,000 to set up an offshore trust. Now there's an annual maintenance cost associated with those. But if you look at offshore or an asset protection trust, much like you do buying liability insurance or malpractice insurance, this is just another form of insurance to protect you and your property. So if we look at how a potential domestic asset protection structure could be set up, where we put different assets and different LLCs to protect each of those assets from each other, all owned by a limited partnership, where the general partner is a domestic or an LLC domiciled here that's owned by your revocable trust, and you transfer the limited partner interest over to an asset protection trust, also domiciled somewhere in the U.S. All of that then flows down to the GST trust, like the previous slide showed. Or you can go the offshore route, which looks an awful lot the same, other than you pick you've set up an LLC domiciled in that foreign country where you would be the manager of that, so you control everything that's going on. You would have an independent trustee of the offshore asset protection trust, but you could serve as the trust protector, which means that you can fire and hire the trustee for any reason at any time. And then again, all of that then ultimately gets distributed down to the dynasty trust. So I know I covered a lot of territory in a short period of time, but hopefully by having this recording, you can and the slides, you can go back over some of these slides. But Angie, I think we're ready for next steps. If you're ready.
I'm ready. Thank you, David. That was great. All right, everybody, I want to talk about what our strategic wealth system model looks like, just a light overview. As we work with you, we want to begin with tax minimization and then getting you to a level where we have control of your money, identifying how your tax planning needs to play out year over year. And then lastly, the very top of our model, and the most important, I think the place where we all want to get to is financial independence. So as we work with you, these are the steps in which we will follow.
And they're also talked about in the book, The Richest Doctor.
Exactly. Let's not forget that book. So our process, I welcome you all to schedule an introductory call with me, and I'll talk about that on the back end as we wrap up. But if we move forward, our process begins with a strategic wealth system model, or strategic tax blueprint, and then we'll begin onboarding and implementation. That's a very important part of our partnership with a new client. And then we also will roll in our year-end tax planning and looking at all the tax savings that we'll create. So how do we get started on tax planning and implementation? I do welcome you to have a call with me. I promise it'll be the best 30 minutes to talk about taxes possible, so we can discuss your tax situation and what our next steps look like. You can use my link, which I think we're going to put it in the chat to schedule, or you can use this QR code and get on my calendar, and I look forward to meeting with you. And as David mentioned, The Richest Doctor, that is his recent book. It's very insightful. I think all of our physicians get something out of it. So please scan that QR code. You guys can read the first 2 chapters for free. And if you like it, you can purchase it on Amazon.
Or cheaper if you buy it from the richestdoctor.com website. It's only $4.99.
Nice. What a bargain. All right, let's talk about Q&A, see what kind of questions we have here. We have a really great one. First off, what additional planning would you recommend as a physician's net worth increases?
So generally, it really kind of depends on what type of property you have and what type of life situation you have. So just coming right out of residency, where you may have student loan debt and possibly a checking account, you may not need anything other than possibly a simple will. If you have life insurance and you want to make sure whoever inherits the life insurance also is going to be it's who you ultimately want to receive that property. As your life advances and you get married, obviously a will and increasingly a living trust becomes increasingly important, and also the ancillary documents that I mentioned before that take care of incapacity. As you have children, now you add a new wrinkle to it, and that is, what happens if both you and your spouse are no longer living, and there's an estate that you want your children to inherit, but possibly not right away. So that's where, depending on your view of having your estate go through probate, either having a will that has a testamentary trust that creates trust for the benefit of those minor children, but probably increasingly more important is going ahead and having that revocable trust that owns all of your property, that also has those provisions for the future heirs. So and then if your estate continues to grow, then you would add then some of those components that we talked about earlier, where you would add either a testamentary charitable lead trust that would zero out any kind of a taxable estate, and or a life insurance trust. But all of those would ultimately feed back into, a long-term trust that once they accomplish the tax purposes, now all of those trusts can merge and now just have one trust that, continues on generation after generation.
Great. Okay, another viewer wants to know, can you briefly discuss the differences between a will-based plan and a trust-based plan? If you have a trust, do you need a will?
Well, the answer to the last question is yes, because you never know if there may have been an inadvertent asset that you might have acquired, or you may have been incapacitated during your lifetime, and so therefore you can't transfer property into your trust anymore legally. But let's say you have someone in your family pass away, and you're now the beneficiary of their estate. Unless they had named your trust as the beneficiary, that money then goes to you individually. So you're going to need to have a will, and in the earlier slides we call it a pourable will, just in the event that you inadvertently left something out of the trust. A will-based estate plan is just one that you have a will that that at the moment of death it determines what property you have and who gets it in your your beneficiaries. It does not have any long-term control over your property. It's just a snapshot of who inherits your property, and that is all then going to be controlled by the probate proceeding of the probate court. A trust-based plan is going to be one where you have all of your property in the trust. It controls when and how much people receive property, and it then goes on potentially for as long as you design the trust to go on. There are some states where you can have a trust that lasts into perpetuity. Most states have a law against that. It's called the rule against perpetuities, meaning that just as the name says, you only can have property go for somebody who's alive at the time you die plus 21 more years. That's how most states are set up, where the trust ultimately has to be dissolved. But there are an increasing number of states that have abolished the rule against perpetuities and allow you to pass that wealth on to many more generations and potentially even perpetually.
Great. And we have one more before we wrap up. Can estate planning address potential malpractice liabilities for healthcare professionals?
Would you say that a question again?
Can estate planning address potential malpractice liabilities for healthcare professionals?
So it's a very broad question, but I would say it's possible to address some malpractice issues. So some planning could happen at the basic level where you have a non-physician spouse that owns all of the property that would otherwise be subject to a malpractice creditor. So that could be one level of asset protection without having to create some of the more advanced strategies that I talked about. If that's not acceptable, generally any trust, and this is important to know, any trust that you can revoke. So, for example, in the previous slides where I talked about having a revocable living trust, anything that you can revoke, a creditor can step into your shoes and revoke as well. So a revocable living trust during lifetime does not provide any asset protection planning. If the person that the grantor of that trust is the one that has the lawsuit filed against them. The only way to have that protection, again, if you're not going to put all of that property that otherwise wouldn't be exempt from creditors into the spouse's name or a separate trust for them, would be to do one of the more advanced strategies, which is either a charging order protection entity, which is that LLC in one of those 13 jurisdictions, or a family limited partnership, or a domestic or an asset protection trust. You're going to need to, if you want to have control over your property, you're going to need one of those more advanced strategies to provide any additional layers of protection.
Great, thank you. I think that was our last one.
Oh, awesome. Well, good questions.
Very good.
Well, I think that wraps up everything that we had for today. So again, I appreciate everyone for joining today's webinar. Really thank you for your time. And if there's anything we can do to help you, I'd love to have the opportunity to have a conversation and just schedule that call with Angie.
Thank you, everybody.
Thanks,
Thank
everyone.
you, David. Thank you, Angie. Appreciate everything as usual. And the insights are so incredibly invaluable. Again, I can speak from personal experience. I have leaned on David and his team for many services, and I've never been disappointed. So thank you again for sharing these insights with our team here.
Thank you,
Great.
guys.
Thanks, everyone.
Bye.
Thank you, everybody.